In this video, we're going to cover the early redemption of a bond. Let's read the question first. On January 1st, 2023, Maidstone Inc. issues a $200,000 10-year 6% bond. Interest is payable annually on December 31st. I did that just to make it easier. The market interest rate at the date of issue is 4%. The company is a public company and therefore uses the effective interest rate method to account for the bond. By April 1st, 2027, interest rates had increased and Maidstone Inc. has cash reserves such that they are able to repurchase 40% of the bond at 90. Maidstone Inc. repurchases the 40% on April 2nd. It should say April 1st. Let's just correct this. There we go. April 1st. 2027. Required. Account for the repurchase. Note, the amortization schedule has been provided for you up to December 31st, 2026. So you can see I've provided the amortization schedule for the first 4 years because that's not what the focus of this video is. All right, so now how do we account for this repurchase? Let's do it in a step-by-step process. Step 1. We have to update the interest expense and the present value of the bond all the way up to April 1st, 2027. So we're updating it for the portion that's actually being retired. We need to be careful to prorate for the period that was actually outstanding, which in this case is 3 months out of 12, because it's being retired on April 1st. And that for 2027 means that January, February, and March is the period of time for which we still owe interest. Now, the simplest way to do this is to divide the value at December 31st, 2026 between the 60% that will continue in the future and the 40% that will disappear. So I'm going to copy the December 31st, 2026 line from the amortization table. I'm going to move my paper up. So I've copied the line from the amortization schedule. I want to renew the line for the 60% that will continue in the future. 12,000 multiplied by 60% is equals to 7,200. $8,960.33 multiplied by 60% is going to be $5,376.20. The difference between these two amounts is $1,823.80. Now, under normal circumstances, and I've seen students do that, they would take the present value and reduce it by this amount. Don't be fooled into doing that. We're only taking 60% of the present value. So in this case, I'm simply going to take the present value and multiply it by 60%. $132,581.13. My amortization schedule will move forward from this point. So at December 31st, 2027, I'm going to use this information to calculate my next line. So if I move forward for December 31st, 2027, I'm going to use that 7,200. I'm also going to take this present value and multiply it by the market rate in order to calculate the implicit interest. That will be $132,581.13 multiplied by our market interest rate of 4%. That's 5,303.25. I'm now going to take the difference, which will show me the amount of the amortization for 2027 based on the present value that we calculated, the 60% of the total present value. $1,896.75. Now we can continue to do what we always do, which is reduce the present value by this amount. $130,684.38. So this is what's going to continue on in the future. But don't forget, we have to deal with the 40% that is being redeemed on April 1st, 2027. So I'm just showing you what's going to happen in December 31st, 2027 when we move forward. Now we're going to deal with the 40% that is being redeemed. I'm going to do the line from the amortization schedule, but I'm only going to recognize the portion that will be redeemed. The portion of the present value that will be redeemed is the difference between the total present value at December 31st, 2026 and the 60% that is moving forward because the company retains the liability. So I'm going to take the difference between these two amounts. $220,968.55, subtract the $132,581.13 that is going to remain as a liability. That is $88,387.42 at December 31st, 2026. This is the portion, the 40%, that is going to be redeemed. When is it going to be redeemed? It's going to be redeemed at April 1st, 2027. Now, note that the period between these two dates is only 3 months. So I've got to recognize the cash portion only for that 3-month period. So how am I going to calculate that? I'm going to take the 40% of the face value. 200,000 multiplied by 40% is equal to 80,000. That's the portion of the face value that I'm going to redeem. Now, if that is the portion that I'm going to redeem, I have to calculate 3 months of interest on that portion. 80,000 multiplied by the coupon rate, which is 6%, multiplied by the number of months that we're actually holding the bond between the last time we paid interest and the point of redemption, 3 months, and divide that by 12 months because it's an annual interest rate. What is this amount? This amount is $1,200. That's the amount of cash that we are going to have to pay the bond holders when we redeem the bond on April 1st, 2027. I'm just going to move my paper up. Now, what is the implicit interest? Well, don't forget the implicit interest is calculated on the present value, and we have the present value, $88,387.42. We're going to multiply that by the market rate of 4%. Then we're going to multiply that by the 3 months and divide it by the 12 months. And this is equal to $883.87. That's the amount of implicit interest that we incurred from holding the bond for 3 months. Don't forget, only the 40% of the bond. Now, the difference is the amount that we have to amortize at April 1st, 2027. $316.13. I can do my usual reducing the present value by that amount. That is $88,071.29. So think about what this means. It means that we owe the bond holders $1,200 for the fact that they have held the bond for 3 months. We have implicit interest, which we, the company, has incurred of $883.87, and the difference is the amount of the amortization between December 31st, 2026, from the $88,387.42 to the current point, April 1st, 2027, to bring it down to $88,071.29. This is the amount of the bond that will disappear. We're going to make an entry to recognize this. And I'm going to do that on a new page. I've got my amortization schedule right here, so I have a reference to do my entry. On April 1st, 2027, we're going to do a debit to interest expense for the amount of the implicit interest, $883.87. We're going to do a credit to interest payable. The amount that we're going to pay our bond holders, $1,200. And we're going to do a debit to the bond payable of the difference, $316.13, which will bring the present value that's right now sitting in our account to $88,071.29. Now, let's move on to step 2. I'm just going to remove this and move up my paper. Step 2. I have to record the repurchase of the bond, and I've got to remove that portion of the bond payable that we've eliminated. Plus, I have to eliminate the interest payable, and I have to pay the cash and recognize the gain. So first, how much of the face value is going to be repurchased? And we know that this is going to be the 200,000, which is the face value, multiplied the 40%, which is what we repurchase. This is $80,000. So that's the amount of the face value that's going to disappear. Now, what is the price we're paying for that disappearance? We're going to pay the $80,000 multiplied by the 90%, which is equal to $72,000. Now, we also have to add in the interest payable that we owe to the bond holders for the 3 months that this portion of the bond was outstanding, which is $1,200. So the total amount will be $73,200. That's the amount of cash that we're going to fork over to the bond holders. So now let's look at the entry we're going to make. We're going to, on April 1st, 2027, we're going to credit cash for the $73,200. We're going to debit the interest payable for the $1,200. Remember that amount we just did an entry for? We're going to get rid of it because we no longer owe those bondholders anything. We're also going to debit the bond payable for the amount of the bond payable, which is going to disappear. And remember, we had that on our previous page. Let's just flip back quickly. We can see on our previous page, here it is. That's the amount of the present value that is going to disappear. The $88,071.29. Let's just take this page away. Now, what is the difference? The difference is the gain on the redemption. So we simply take the amount of the debits, subtract the amount of the credits, and we get $16,671.29, which is the amount of the gain that we're going to show on our income statement. So let's just recap. In our first step, we alter our amortization schedule for the amount that we're actually going to carry forward. In this case, the 60% that will move forward to future years. We then calculate the portion that will be redeemed. So this, of course, is the amount that will be redeemed, taking into account the proration for the number of months that it's been outstanding, which is only 3. Once we have this updated amount for April 1st, 2027, we can move forward with our first entry to recognize the interest payable, the interest expense, and also the updating of the bond payable present value amount. Step number 2 is to recognize which portion of the face value will disappear, what is the amount that we will pay to make it disappear, add in the interest payable that we owe to the bondholders, calculate the total price, and then do the entry. Eliminate the interest payable, recognize the cash, get rid of the bond payable that's going to disappear, and the difference in this case is equal to a gain on redemption. Note that it's possible in other scenarios that this outcome will actually be a loss on redemption, in which case we're going to see a debit to a loss on redemption instead of this credit to the gain on redemption. This process to account for the repurchase of a portion of the bond is fairly complex, and I suggest you do some additional questions to make sure you can master it. Thanks a lot for watching.